Hello, my dear students. Welcome back to part 2 of revision for accounting standards for Group 1. I hope you are able to see me and hear my audio. I'll be sharing screen in some time. We'll wait for a couple of minutes.
Hello, my dear students.
Till the time other students join in. Right, so let me just share my screen. Let me know if you're able to see the screen. Group 2 will let you know when we would be conducting Group 2 session. Let us first finish Group 1. I'm sharing my screen. I hope you are able to see the screen. Yeah, if yes, you can just give a thumbs up. If you have not yet subscribed to the channel, do subscribe because whenever we conduct sessions and all, you will get to know. So in the previous session, we covered from Accounting Standard 1 till Accounting Standard 10. Today, we will be taking up Accounting Standard 11. One standard which in Group 1 students find some level of difficulty and they are actually concerned. They are sometimes they're scared that how should we handle when Accounting Standard 11 related questions are asked. But let me tell you, this is a very simple standard again. It is purely logical based. Once you understand the underlying logic, then solving problems from the standard will not be difficult. Okay, difficulty would arise, rather complexity would arise when you learn forex management in strategic financial management in CA final. But for now, I don't think the standard poses too much of a challenge for the students, right? So I think it's 3 o'clock and we are good to start off with the session. Yeah, we are good to start off with the session. Okay, so Accounting Standard 11, this deals with the effect of changes in foreign exchange rates, right? So the title of the standard is Effect of Changes in Foreign Exchange Rates. Now, when would this situation arise? Whenever an entity is transacting in a foreign exchange. So to put it very simply, let's say there is a company based out of India whose functional and whose reporting currency is the INR. If they are transacting in US dollar, how should they account for effect of those changes? So let us say Infosys is selling goods or selling not goods, sorry. If Infosys is selling its services to a foreign company, it is exporting its services to a foreign company, then maybe the billing is done in INR. Maybe the billing is done in INR. In that case, no problem. But in most of the cases, whenever there are exports to a foreign company, then billing might be done in US dollars. Now, if the billing is done in US dollar, for reporting purposes in India, you have to record them in INR. Now, this standard gives guidance as to how should you record those transactions, how should you, settle those transactions, what happens when there are changes in foreign exchange rates. To give you a perspective, when I was doing my articleship, the exchange rates used to be 40 to 45. When I was, working as a CA in companies, the rates used to be 60 to 63. That is the rate which I used to use, which I used to close the books of accounts. Today, you can see the rates are 73, 74. So what happens when the foreign exchange rate changes and how should that be accounted for? Now, before moving on to the accounting aspect, we need to understand two critical terms, which is monetary items and non-monetary items. These are basically classification of assets and liabilities. Now, what do I mean by monetary item? Something which is fixed in money terms, meaning to say, you can determine or you can tell for sure what is the amount in terms of money you would be realizing if you sell off that asset, or the money that you need to pay to settle a liability. For example, there is a debtor. That debtor has to pay you 1000 rupees. Now, is this 1000 rupees fixed? Yes, it is obviously fixed. It is not going to change. Maybe the debtor may become bad debt, then that's a different thing. But can you say tomorrow that the debtor will pay me 1500? You cannot say that because the amount is fixed. Such items are called monetary items. Example could be loans. If you have borrowed loan from any bank, what is the amount that you need to repay back? That amount is fixed. What is the interest that you need to pay back? That amount is also fixed. So these items are money. Monetary items are money held, so that is obviously a monetary item, and assets and liabilities to be received or paid in fixed or determinable amounts of money. Meaning to say, the amount that you will pay is determined, it is fixed, right? Now, examples as I told you, debtors, it could be loans, it could be trade payables, it could be sundry creditors, what you may call. All of these are known in terms of money. They will not change. There may be a bad debt case. There may be a settlement discount and all of that. But the amount that you will receive is fixed and determined. These are called monetary items. Then what are non-monetary items? For which the monetary value is not fixed if you want to realize that asset or if you want to settle that liability. For example, there is a plant and machinery which the company has purchased. You may get future economic benefits, but do you know what is the amount you will get if you have to dispose of that asset? Or can you for sure say that this is the exact present value of future economic benefits, this is the amount that you will realize if I settle? That is not possible. So such items are called non-monetary items, right? So there could be, let us say, I've invested in equity shares, those are non-monetary items. If there are preference shares are also non-monetary items, because when the company gets wound up, or if it is being liquidated, you may not have sufficient money to pay back to the preference shareholders. So even those are non-monetary items. Now let me ask you one question: is inventory a monetary item or a non-monetary item? So let me look at the responses. Is inventory a monetary item or a non-monetary item? Monetary, non-monetary, monetary. Now please note, to call something a monetary item, we are getting multiple responses. Some are saying monetary, some are saying non-monetary. Is it an asset to be received in fixed amounts of money? You may say, as per our previous discussion, it will be valued at lower of cost or net realizable value. That value is fine. But do you know what is the amount you will receive when you sell that inventory? You do not know. Maybe once you sell the inventory may be sold at still a lower rate, right? So inventory is not a monetary item. Inventory is a non-monetary item. Once you sell it, once there is a debtor in place, that becomes a monetary item. Inventory is not a monetary item, it's a non-monetary item. A lot of students get confused here, but you can just note it down somewhere that inventory is non-monetary because the amount that you will receive, is not fixed and determined. The value keeps on fluctuating till the time you sell that particular item. Okay. Now, having understood this, let us understand the accounting aspects related to foreign exchange rates. I'll take a simple example and I'll run you through the example so that you can understand what is to be done when there is a liability to be settled or exchange rate changes. We'll understand that. Right? So let us say there is a company in India, Infosys, and there is a client in US. For example, let us say Amazon US. Okay, this is based out of India and this is based out of US. What is the currency which Infosys would use to report, to prepare its financial statements? INR. And while selling, let us say the sales happen in dollar terms. And on a particular date, let us say on 1st of January of 2021, Infosys sold services worth $10,000. Infosys sold services worth $10,000. Now, the amount is not yet received. Amazon has not yet paid the amount. There is a 6-month credit period which is provided. Okay. Now, what is the entry for sale? You would say Amazon account debit. By how much? $10,000. But you will not be recording this at $10,000. You will convert that into equivalent INR. At which rate? The rate prevailing at the time of transaction. Now, see, the exchange rates keep on fluctuating. Okay, second on second, the rates will fluctuate. So it can be on the basis of the date of the transaction, maybe the closing rate of that date, or maybe average rate of that date, or maybe the bank quoted rate on that date, or it can be anything, but there has to be consistency. So an entity may say we will follow RBI reference rate. We may follow RBI reference rate. Some entity may say we will follow the rates given by the banks. So the corresponding banks, whatever rates they give, that is the rate that we will be following. Okay. Some may say we will take the average. All of that is fine. So on this date, whatever is the rate, at that rate you will book this transaction. So assume for a moment on this date, the exchange rate, that means amount of rupees that you will get when you sell $1 is, for example, 75. Okay. So what is the value? 10,000 multiplied by 75, you get 7,50,000, right? 7,50,000 Amazon account debit, then to sales 7,50,000. Done, no problem, right? Now the year ends on 31st March of 21 and the amount is still outstanding. Okay. What the standard says is all the monetary items should be restated when the financial year ends. All the unsettled monetary items should be restated when the financial year ends. Now, is this account a monetary item? Yes, it is a sundry debtor and it is a monetary item. So you have to restate this amount. You have to restate this account. What is the value that you should use to restate the amount? The closing rate. What is the closing rate? Say, for example, in our case, the closing rate is 70. See, when we sold when the rate was 75, $10,000, we would have got 7,50,000. Because on 31st March of 21, the rate is 78, which means we will get 7,80,000. 75 multiplied by 10,000 is 7,50,000. 78 multiplied by 10,000 makes it 7,80,000. Means you will get more. If you get more, is there a gain? Yes, there is a gain. So the standard says this gain should be recognized in the P&L for a restatement of all monetary items. It can be a purchase for which there may be a creditor. Exchange rates would have increased. There is a loss. That loss also should be recognized. All profits or losses or gains or losses arising out of foreign exchange transactions will be recognized in the statement of P&L. Now you may have a doubt. What if Amazon paid us the amount on 20th March? Possible? Yes, possible. So there could be a scenario where Amazon paid us the amount on 20th February. Sorry, not 20th March. I'm saying 20th February. And the exchange rate is 76. What will happen in that case? This is option scenario 1. In this scenario, you will receive 76 multiplied by 10,000, $7,60,000. So bank account debit will be 76 multiplied by 10,000, $7,60,000. Okay. Then to Amazon account. Amazon, the balance is 750 only. It is not increased. The difference will be gain to exchange gain. What is the exchange gain? 760 minus 750. Exchange gain means basically foreign exchange gain. This is the gain that you will recognize. This is the first scenario. This is the first scenario. If the transaction is settled, any gain or loss arising, this will be taken to P&L. Now assume the transaction is not settled on 31st of March, the exchange rate is 78. What would you do in that case? Now amount receivable is not 750, amount receivable is 780, considering the exchange rate on 31st of March. So you would say Amazon account debit 780 minus 750, 30,000 to exchange gain. This is unrealized. Okay, exchange gain unrealized 30,000. Even though if it is an unrealized means you have not yet received in terms of cash. Even in that case, you will credit it to the P&L, right? So this is the gain on restatement of debtors, right? So any exchange gain or loss arising out of settlement of a foreign exchange transaction will be taken to P&L. Either you will debit to the P&L if there is a loss, if there is a gain, you will credit to P&L. Now assume for a moment this transaction was settled on 30th of June of 21 when the exchange rate is 77. Now tell me, what will be the gain or loss that should be recognized in the period ending 30th June of 21 or in the financial year 21-22? Initially, we recognized it at 75. Then the rate was 78. We recognized a gain of 30,000. Now the settlement happens when the rate is 77. What should be the gain or loss that should be recognized in the P&L? Okay, so we're getting responses. 10,000, loss of 10,000. Okay, others, do you think loss of 10,000 or gain of 20,000? Guys, you need to participate. Only when you participate, you will take some knowledge out of this session. This is not a session just to sit and listen. Okay, so 10,000 is the loss. I think that is what has been the response. So you will recognize a loss of 10,000. Now the entry would be bank account debit. You would get 77 multiplied by 10,000, that is 7,70,000. To Amazon account. How much is the Amazon account standing at? Initially we had booked at 750. Now we added 30 to this, it became 780. And to exchange loss of 10,000. To exchange loss of 10,000, right? So net 30,000 of gain and 10,000 of loss. Net gain is 20,000, but 30,000 will be recognized in the financial year ending 31st March of 21. This is scenario 2. Okay. And here in the year 21-22, you will recognize a gain of 10,000. This is the underlying fundamental principle of this accounting standard. All the monetary items have to be restated on the balance sheet date. That is one thing you need to remember. And that will be, you will apply the closing rate for monetary items. That is the second thing you need to remember. If the transaction has been settled, any gain or loss arising out of that settlement of transaction will be recognized in the statement of profit and loss. Right? Simple. I don't think there is much complication here. Okay. But always remember, you are restating only monetary items. We are not restating the non-monetary items. We are restating only the monetary items. So exchange difference, the difference resulting from reporting the same number of units of foreign currency in the reporting currency at a different exchange rate, that is the exchange rate difference. Foreign currency transaction initially we recorded at exchange rate on the date of transaction. Then foreign currency monetary items, you will value them at closing rate. Exchange difference, you will take it to P&L. So it could be, it need not be always an expense, it can be an income also. Okay, so it can be an income as well as an expense in the respective financial year. Now there is an exception given by para 46A. Now this is one aspect which is frequently tested in the examination. This was introduced when I was a student of CA final, right? When I think 2008 or 9, when there was this global crisis going on and exchange rates were fluctuating wildly, and the companies had to take a lot of these expenses hit because of depreciation of INR. So what the government came up and said is, if it is in relation to, if there is a monetary item in the balance sheet in relation to depreciable asset. So what does that mean? Say for example, a company has taken a loan of $100,000. Okay, loan taken is $100,000. Rate when the loan was taken is, let us say, was 45. Rate on which the loan was taken is 45, and rate on balance sheet date is, let us say, 50. Okay, so what happens? You have taken a loan. When you took the loan, you booked it at 45. Now the rate is 50. There is a 5 rupee loss. So the loss is 50 minus 45, 5. So total loss, $1 lakh multiplied by 5 lakhs in INR terms. This is the loss. General rule is what? Debit to P&L. Okay, but what happened was, during that period, companies had crores and crores of losses on account of foreign exchange differences. So what the company said is, if we start reporting these losses, our balance sheet will be really damaged. It will not give a true picture because this may be a temporary phenomena. So government introduced this para 46A where they gave an option to the entities to capitalize this exchange difference, to capitalize this exchange difference, to capitalize this exchange difference. Now, please understand, this is an option which has to be exercised, and once exercised, you have to continuously follow that. So let us say this year there is a loss, you will add it to the cost of asset. If there is a gain next year, you will reduce it from the cost of asset. So you will adjust it to the cost of that particular asset. It is not that whenever there is an expense, I will capitalize, and whenever there is a gain, I will take it to the income statement. That is not permitted. Once you have taken this option, you have to follow this consistently. That is the first thing. Second thing is, you will also understand in accounting standard 16 that the exchange losses which compensate for the interest savings, to that extent you will consider them as borrowing costs. So that is a separate treatment altogether. Okay, here whatever is the exchange loss which comes within the purview of AS 11, to that extent what you need to see is, if the entity chooses the option under para 46A, then you can capitalize, that is add it to the cost of asset or reduce it from the cost of asset. Otherwise you will expense it off. Okay, so exchange differences in respect of a depreciable asset, if the entity chooses, we can adjust it to the cost of the asset. In other cases, meaning to say where there is not a depreciable asset, it may be a non-depreciable asset, or it may be some other item of non-monetary asset presented in the balance sheet. In that case, you will accumulate it to FCMI TDA account. What is this FCMI TDA account? Foreign currency monetary items. So we are talking about monetary items. Translation difference account. Translation difference. You will accumulate in this account and amortize it over the life of that particular asset. Okay. So this is the rule that is generally followed. As far as non-monetary items are concerned, you will use the exchange rate on the date of transaction, or if fair value approach is being followed or revaluation model is being followed, you will use the exchange rate on the date of valuation. So for inventory, you will use exchange rate on the date of valuation of the inventory. For fixed assets, you will use the exchange rate on the date of transaction. Now, this is for conversion of non-monetary items. Now, where would we apply this concept? You would apply this concept when it comes to foreign operations, where they have integral operations and non-integral operations. You will apply this principle. And also, there would be a lot of application of this when you learn about accounting for branches in a separate chapter, right? So I hope this discussion, this brief discussion makes sense. If you have any questions on this, you can just let me know. Exchange rate should be debited. Oh, sorry. Can make mistakes. Okay, guys, you understand the underlying substance over form. Substance is it is debited. I have written in the debit column. Yes, I should not have written 2 here. Okay, good that you caught that. You should be good auditors. You should be able to catch such mistakes. Okay, just because some CA has passed the entry does not mean that it is always correct. Abhishta says unable to understand the entries. So it is. I think I have explained the entry as I was computing. If you have missed the initial part, you can go back. So services were sold 10,000 into 75. It is 7,50,000. Scenario 1, exchange rate is 76. So the total amount is 7,60. 10,000 is the gain. Closing rate, if it is 78, then the gain is 30,000, because 78 multiplied by 10,000 makes it 7,80,000. Minus 7,50,000, there is a gain of 30,000. Okay. Then when you actually realize, you realize 7,70,000, exchange loss of 10,000, and Amazon account 7,80,000. Is there any compulsory rule to follow? No, there is no. It's an option. Add the option of the entity. If they want, they can use it. If they feel that it is fine, perfectly fine. If you don't want to use that, then that is also perfectly okay. FCMI TDA is, just write it here, foreign currency monetary item translation difference. Now, what does this mean? If the entity chooses to apply this para 46A option, if it is a depreciable asset, you will either debit or credit to the corresponding fixed asset or PPA. Okay, if it is not a if it is not a not a depreciable asset, then you will accumulate this difference to, you will debit or credit the difference to FCMITDA account. You will debit or credit the difference to FCMITDA account. Okay. Now, what will you do with this balance of FCMI TD account? Over the life of that asset, you will amortize it systematically. Okay. Now, such depths of questions are not tested in the examination. If you just understand that it has to go to FCMI TDA account, or if it is related to depreciable asset, you will debit or credit it to fixed asset. That is sufficient. Okay. Right. Moving on, we have these foreign operations, which is also covered as a part of your accounting for branches. So I'll just be covering that part which relates to foreign operations. Foreign operations means there is a, let's say, an Indian entity, it has an operation outside India. Maybe there is a branch office outside India. Maybe there is a subsidiary outside India. Now, they have been classified into two categories, integral and non-integral. Integral means it is as if the branch is also a wholesome part of the entity which is reporting the transactions. So let us say in India, you have Infosys or you have Amazon, right? Now, Amazon is a US company, but assume for a moment Amazon India. Amazon India has a branch in US. Assuming Amazon India is an Indian company, it has a branch in US. Now that branch in US, when we say it is an integral part of the operation, means most of the things are controlled by the head office in India. Branch is acting at the full instruction of the head office in India. They are taking very few independent decisions. It is just like an extension of the company which is based in India. That is what is called an integral operation. Foreign operation being integrated. What is non-integral? Non-integral is like an independent branch. They take their own decisions. They take their own purchase decisions. They take their own sales decision, credit decisions. Whatever has to be done, they take it independently. They are very less dependent on the entity present in India. But if it is an integral operation, maybe that integral branch is just selling the goods supplied by head office to that particular location. Okay. So integral means as if they are the same or extended part of the entity which we are discussing about, right? Now, because it is an integral operation, individual transaction, how should we account for? As if they are entered by the entity itself. Meaning to say, had the entity entered into those transactions, what is the principle you would have applied? Exchange rate of that date of transaction. So using that rate itself, you will do the accounting for transaction. As far as fixed assets are concerned, whatever is the date of acquisition, or if you have done fair valuation under the revaluation model, on that, whatever is the rate on that date, you will use the exchange rate. Inventory, the date on which you incur the cost on inventory, or the date on which you value the inventory, that is the rate which you will consider. Any difference will go to P&L. Remember, differences arising on foreign exchange transactions should go to P&L. So for integral operations, if there are any differences which arise, when you are translating those foreign currency transaction into the Indian accounts, in that case, whatever is the difference, that will be taken to P&L. So generally what happens in these cases is the foreign branch may prepare a trial balance. That trial balance, you will convert it into INR using these principles. And whatever is the exchange gain or loss, you will debit or credit to P&L. That is for integral operation. When it comes to non-integral operation, all the assets and liabilities will be converted using closing rate. So here you are using the transactions rates, the date existing on the date of transaction, or maybe you may using a weighted average rate. Here you will always use the closing rate. Income and expense, you will use the date of transaction, and whatever is the exchange difference which arise because of this translation, you will accumulate it in translation difference account. And what do we do with this translation difference account? When the foreign operation is disposed of, you will also transfer this amount to the reserves, right? So this is how you deal with integral operation and non-integral operations. Whether exchange gain is taxable as per the income tax? Yes, obviously, if you realize more amount, it will be taxable, right? Then a small discussion with respect to forward exchange contracts. For this also, you need to understand an underlying concept. Say, for example, in the case Infosys, When will Infosys receive that amount? Infosys will receive the amount on 30th of June from Amazon, $10,000, right? Infosys will receive this amount of $10,000 on 30th of June of 21. Now, does Infosys know what will be the exchange rate on that particular date? They will not know. Infosys will not know what will be the exchange rate on that particular date, correct? So, in such a situation, if Infosys does not want to, have any of this exchange rate risk, what it can do is it can take a forward contract. There is something called a forward contract. Now, what is a forward contract? Forward contract is basically a contract entered into today to exchange this foreign currency at a future date at a specified rate. So for this, we need to understand a few things. Spot, that is today's rate. Let us say today's rate in the market is 75. When the transaction happened, the rate is 75. Okay. In future, we do not know what will be the rate, but generally what happens is, because US dollar interest rates are lower, Indian interest rates are higher, also inflations are different, purchasing power parity is also different. Because of all of these reasons, don't worry, you'll understand this in CA final. The INR would depreciate against the US dollar. So if you see a trend, I was mentioning, right? I have seen this at 45 around in 2006, 7, and 8. It went up to 62 in around 2015. So this was what was in 2000, let us say, 8 around. I don't know exactly the year. This was around 2015, and we are in 2021. It is 75. So over a long-term period, you will see that the Indian currency is depreciating. Now, Infosys wants to safeguard its position. So what it can do is it can enter into a forward contract. Forward contract means what? Contract to. Now, since Infosys will receive this $10,000, they have to sell this $10,000 after 6 months. So contract to sell $10,000. Contract to sell $10,000 on 30th of June of 21 at. Now, what could be the rate? Rate will be generally the higher one. Okay, so they will negotiate it with the bank or based on the market rate. Let us say the rate is 77. The rate is 77. Now, what happened here? Understand this transaction very carefully. You'll be able to understand the forward premium and amortization related concept. Today we sold at 10,000. The rate is 75. After 6 months, when I receive $10,000, I do not know what will be the rate. So today itself, I go to a bank and say, boss, after 6 months, I'll be receiving $10,000. I am selling this $10,000 to you after 6 months. You agree for a rate. Bank says, okay, we will buy at 77. Now, on the date of 30th June, exchange rate may be 100, exchange rate may be 50. This contract will be settled at 77. This contract will be settled at 77. Now, this 77 is called the forward rate. This 77 is called the forward rate. Okay. Now, the difference between forward rate and spot rate. See, there is also concept of cash rate, spot rate. I'll not get into all of that. Spot rate means today's rate. Just understand that. Okay. Difference between the forward rate and spot rate is called forward premium. Difference between the spot rate and the forward rate is called forward premium. Now, it can be forward premium received or forward premium payable. It could be both of them, both the things, right? Now, in our case, 77 is what we will receive versus 75 today. So 2 rupees is extra that we will be receiving for $1. That is called forward premium. And what do we do with this forward premium? Forward premium will be amortized over the period of contract. Now, what is the period of contract in our case? We sold the goods on 1st of January. 1st of January of 21 till 30th of June of 21. 6 months period, right? 3 months fall in the first period, first financial year, 3 months fall in the second financial year. So this forward premium in our case, which is at 77 minus 75, which is 2. This forward premium, 1, so I'll just put a year here, 31st of March of 21. Okay, so 3 months period, half of it will go to this period. So which is 1, and balance 1 will go in the next period. So this is called amortization of forward premium. Now here I gave an example of a receipt. Similarly, there could be an example of payment. I do not want to take the risk. and I enter into a forward contract with the banker or with another party, I agree for a higher rate, there is a forward premium payable. That forward premium payable will be amortized over the period of the contract. Amortized means what? This will be credited to P&L. Okay, in the respective period. If it is an outflow, if it is a payment, then it will be debited to the P&L over a period of the contract, right? This is what is called forward premium and the accounting treatment. Now, some of you may be wondering about how this will happen in the accounting aspect. Let me quickly, give those entries to you so that there is no confusion. On sale, what happens? Amazon account debit 75 multiplied by 10,000, 7,50,000 to sales 7,50,000. This is one thing that would happen. Okay. Ignore the restatement at the end of the financial year. That is already what we have understood. Now, when you enter into this transaction, what is happening? You are entitled to receive INR. You have to give the dollars and you are entitled to receive INR. Okay. So that INR, whatever you are entitled to receive, is after 6 months. What is the value today for that dollars? The value today for that dollars is 7,50,000. After 6 months, you will be receiving 7,70,000. This is after 6 months. But what is the value today? The value today is 7,50,000 only. The value today is 7,50,000 only. Okay. Now, after 6 months, when you receive this amount of 7,70,000, what do you need to give? You need to give them dollars. You need to give them dollars. How much of dollars do you need to give? You need to give them $10,000. The $10,000 worth today is 7,50,000. The $10,000 worth today is 7,50,000. So you have to give 75, $10,000 multiplied by 75. 750 is what is payable. You will receive receivable on that day will be 770, and the balance is forward premium, which is 770 minus 750. So debit, credit, credit. Now you may keep different nomenclatures when you're working, passing these entries. These entries will not be tested in the examination. I'm just showing you how these entries are passed. Now this forward premium of 20,000 will be transferred to the P&L over a period of 6 months. So 3 months, that is 10,000 will go in this period, 10,000 will go in the other period, right? This is the gist of accounting standard 11. Maybe we'll get some, get a chance to pick up a question from the past exam questions, if at all it has appeared, and we'll try to solve that as well. Okay. So what did we understand? Premium discount is amortized over the life of the contract. This is when it is not done for speculative and trading purpose. Now, what is this not done for speculative and trading purpose? The cases that we have seen here, the intention of the company is not to speculate. The intention of the company is not to trade. What is the intention of the company here? Intention of the company is to safeguard the cash flows. They would receive $10,000. They don't want variability in the cash flows. They are doing hedging. We call it hedging. But if it is done for speculative purpose, then all of this is not relevant. Forward premium amortization, discount amortization is not relevant. What happens in that case is you will do a mark to market at financial year end or at the time of settlement, and whatever is the exchange gain or loss on that transaction will be transferred to P&L. So instead of doing this settlement, let us say, instead of doing this today, what do? I feel the dollar will go up, so I'll buy dollar futures. Okay, there is another concept called forward. This is concept is same like forward, but I as an individual may not be able to enter into a forward transaction with a bank. So what I would do is I would buy dollar futures in the market. Okay, now if I buy dollar futures in the market, let us say today's rate is 75. 31st March, the rate becomes 77. And let us say I bought $1,000. Right? So if I bought $1,000, 77 minus 75, 2 rupee per dollar is my gain. So 2000 will be gain credited to P&L. Okay. And let us say I sell it off on 30th of June at 78. Okay. So what is the gain now? 78 minus 77, 1 rupee is the gain. 1 multiplied by 1000, this will be credited to P&L. So if I am holding it for speculative or trading purpose, then the difference between the rate of transaction and the closing rate or the settlement rate will be credited to P&L. Our study material has a problem where they have not done this MTM, but which is incorrect as per the standard. Also, as per the general practice, you have to do a mark to market. So whatever is the closing rate, at that rate, you have to calculate the gain or loss and credit or debit to the P&L. Okay. So this is with respect to foreign exchange. Let me see if there are some questions which you guys have put up. So I don't know. So see, even whether I write or whether I type, I think writing would be, I found, writing would be better because you just need to follow the text that I have written. And amounts also I am multiplying. Even if I write, so this all the cases, I think I have given you the exchange rate references, right? 75 into 10,000, 750. In fact, what I can do is, I will upload this Excel as a part of this, YouTube description, so that you can refer to this if you want to go back and see these notes, right? And what I suggest as a general suggestion to the students also, try to get a hang of Excel, because this is what you will be using the most once you are doing your articleship and once you qualify. Okay. So in fact, we do have an Excel course also, but regarding cash flow, I'll come back, Kalyan. Let us not break the chain of discussion. Towards the end, I'll take the query. Okay. So I hope others are not finding it difficult in understanding whatever I'm doing it on the Excel. If so, please let me know, because I think whether I write or whether I type, it would be same. That is my understanding based on so many sessions I have taken. Right. Okay. So let me just take this quick query of Kalyan on TDS refund and tax refund. See, if it is TDS refund, so you'll net it off from the taxes paid because you have received. Okay. Tax refund also, you'll reduce it from the taxes paid because tax is received. If tax has been deducted, then you will show the income amount at gross value and tax as a separate item of outflow. Okay, bad debt recovery would anyway be credited to P&L, and there automatically it would come into the cash flow statement, right? So now moving on to the next part, again a simple standard, a highly scoring standard, accounting standard 12 on accounting for government grants. Again, even in the standard, there are 2-3 simple principles that you need to remember, and once you remember them, you'll be able to solve the examination problem. And again re-emphasizing that this kind, whatever is the question which is coming from an accounting standard, you should not be making silly mistakes and losing out on marks. I'm telling you, 20 marks can be straight away into your pocket, or at the most 16 to 18 marks will be straight away into your pocket if you master these accounting standards. Apart from that, obviously cash flow and investment accounting, different questions do come, but what is needed is this gist of the standards, and not making those silly mistakes in the examination, right? Now coming to government grants. What are government grants? These are transfer of resources by the government to the entity. You set up some plant somewhere, government say, okay, we'll give you 10 crores, or you give employment to so many people, we'll give you some grant, or you get some technology, we'll fund that technology. You build some plant in backward areas, we'll give you some funding and all of that. That is called government. Those are called government grants. Now, the key question which is dealt in by accounting standard 12, as far as accounting for government grants are concerned, is when should you recognize the government grant? When should you recognize the government grant? So, two things have to be satisfied. There has to be an assurance, a reasonable assurance that the enterprise will comply with the conditions attached to the grant. See, nobody will give you grant for free, right? Even if your parents tell you that, we'll get you an iPhone if you pass the exam, there is a condition attached. You pass the exam, you'll get your iPhone or get your bike or whatever it is. Okay. So for the company also, when the government is giving some amount, there are some conditions attached to it. And what are those conditions? There would be some conditions which the enterprise should comply with. That is the first thing. And secondly, there has to be an assurance that the grant will be received. See, if the government simply says we'll give you grant, but there is no assurance that the government will give us grant, then it is not a government grant. Okay. You can call it by the name of subsidy. You can call it by the name of grant. You can call it by the name of, some amount given, whatever is the nature. These two conditions have to be satisfied. Conditions should be satisfied and grant should be received. And there is a reasonable assurance that these two things will happen. Now, once the recognition criteria is met, next is obviously accounting. Now, accounting can be bucketed into multiple aspects. One is non-monetary asset. Non-monetary asset given free of cost. We just now understood the example of non-monetary asset. If any non-monetary asset is given free of cost, then it has to be accounted for at nominal value. Say the government says, okay, you set up a plant here, I will give you, land. Set up a plant here, I'll give you land free of cost. So when there is no value attached to it, how will I pass the entry? I cannot say land account debit, capital reserve. What is the amount? So it says nominal value. Nominal value could be 1 rupee, 10 rupee, 100 rupee. Why should we record it? To show it in the balance sheet, show it in the face of the financial statements that land has been received free of cost. Land has been received free of cost. So that is one thing. Non-monetary asset, you will record it at nominal value. Okay. Then there could be monetary grants, actual financial resources being transferred. Now for this, we have to discuss under different heads. So one is with respect to depreciable asset. Now, what is this depreciable asset? How should we account for this? Option number one, reduce it from the cost of asset. So let me just, write entries for this. Cost of asset is 10,000. Okay. I'm purposely taking a lower number. Grant receivable or received is, let us say, 6,000. Two options. Option number one, reduce it from the cost of asset. What is the meaning of that? The meaning of that is this grant should be credited to the asset account. So you will say to asset. How much? 6,000. Okay. Then what is the debit to? If grant is received, you will say bank account, or you would say grant receivable. How much? 6,000. Are you clear? Bank account to asset account. What is this entry for? Receipt of grant. Receipt of grant, 6,000. 6,000. Bank account debit, asset account credit. This is option number one. What is option number two? Can anybody tell me what is option number two? You would have learned that and revised that by now. Sums will take it up from the exam questions actually to give you a feeling of how you can score those 20-25 marks. Example for depreciable and non-depreciable asset. Depreciable asset, plant and machinery. Non-depreciable asset, land. Land has an indefinite useful life. So, depreciable asset. Deferred grant account or deferred income account. So, you can set up a deferred income account. So, you will say bank account debit 6,000 to deferred income or deferred grant account 6,000. Please write narration in the exam. I am not writing because I am not writing the exam. You have to write narration in the exam. Otherwise, marks will be deducted. I'm telling you. Okay, you will at least they'll deduct 1 to 2 marks for not writing narration. Right? So bank account debit to deferred grant account. This is the second option. Now, in the first option, what will happen? Fixed asset. Cost is 10,000. Cost is 10,000 less grant 6,000. Carrying amount will be 10,000 minus 6,000, 4,000. This amount will be depreciated over the life of that asset. So let us say useful life is 4 years. I'm making my life easier. Useful life is 4 years. Depreciation will be 4,000 by 4, 1,000. Every year you will charge depreciation of 1,000. So year 1 depreciation of 1,000, year 2 depreciation of 1,000. Let us say value at the end of year 2 is 4,000 minus 1,000 minus 1,000, 2,000. Okay. Value at the end of year 2 is 2,000 after charging 2 years of depreciation. Under deferred income, what will we do? Fixed asset cost 10,000. Useful life 4 years. Depreciation per year will be 10,000 by 4, 2,500. Every year you will transfer, or you will charge depreciation of 2,500. Then what do we do with this deferred grant account? Proportion of depreciation, in the proportion of depreciation, you will transfer from deferred income account to other income. Now, what do we mean by in the proportion of depreciation? Here, depreciation is on a straight line method. So, amount to be transferred to other income will be 6,000 is the total income divided by 4. Every year you will transfer 1,500. What is the net impact? Depreciation debit 2,500, other income 1,500, right? Net impact 1,000. Here also net impact 1,000. So net impact does not change. If you are using deferred grant approach on the basis of depreciation, generally the question will be on straight line method only. So you simply transfer this 1,500 every year to the profit and loss as other income, right? So the second option is deferred income and transfer to P&L on the basis of depreciation. Agreed? Okay. Then what if it is a non-depreciable asset? If the conditions to grant are already fulfilled, then you have to transfer it to capital reserve. If the conditions related to grant are already fulfilled, then you will transfer it to capital reserve. If conditions are not yet fulfilled, you have to fulfill those conditions in the future, and you will be incurring some expenditure to fulfill those conditions in the future. You will transfer it to deferred income, and again systematically on the basis of expenditure, you will transfer that amount from other income to from deferred income to other income. Okay. Then what do we do with grants related to revenue? Revenue means if it is not a grant related to asset, the company may say, the government may say, you give employment to 100 people, we'll give you grant. You, or the company may say, you do this, development of this particular area, you do some expenditure on this, society, we'll give you some grant, right? You run a school, we'll give you grant. Now, something which is not related to an asset. If it is a grant related to revenue, then you will take it to deferred income. You will credit it to deferred income, and you will recognize it systematically over the period in which expenses are incurred to fulfill the condition. So let us say the government says you employ 100 employees, give them employment for 3 years, we'll give you government grant. Okay. What will you do? You will take that amount to deferred income. Now, to engage those 100 employees, you are incurring certain employee cost. In that proportion, you will transfer the amount from deferred income to the profit and loss as other income. Now, two presentations are possible: gross basis and net basis. You can show the expenses on gross basis and this amount as other income, or you can reduce this other income amount from the respective expenses, right? So in the proportion of the expenses that are being incurred, you will transfer the amounts from deferred income to the other income account, right? So this is the broad treatment of government grant which are related to revenue or which are not related to asset. Then sometimes there may be a grant in relation to a promoter contribution. Promoter contribution means it is not specific to one asset. It may be to the undertaking as a whole without identifying specific assets. So we call those grant as grant in the nature of promoter's contribution. If grant is received in the nature of promoter's contribution, you will credit it to capital reserve. Okay. Then sometimes grant may be given to compensate past losses or financial loss. Let's say during COVID, government may come up with a policy and say that, okay, every company in this particular area, because of losses due to COVID, will give them, let us say, 1 lakh rupee, for example. Okay. Now this 1 lakh is not for future conditions to be satisfied. Conditions are already satisfied. There was a loss and the government gave us a grant. In such a case, you need not take it to deferred income because there are no conditions to be fulfilled in the future. Losses has already been incurred. They are giving it as a package that you can directly credit it to P&L, and you will treat them as extraordinary item if required as per AS5. If that fulfills the criteria of extraordinary item, generally it would be the case, you will recognize that item as an extraordinary item as per AS5. But in a nutshell, if it is in relation to a depreciable asset, reduce from the cost of asset or take it to this deferred income account. Otherwise, if it is for non-depreciable asset, either to capital reserve or to deferred income. If it is in relation to revenue, defer the income and recognize it over the period in which you will incur the expense. Now, what if the conditions have been already satisfied? What if the government comes and says, because you had employed 100 employees in the last 3 years, we are giving you grant. There are no future conditions attached. Then you will take it to P&L directly. Promoters contribution, capital reserve, and past losses and financial losses credited to P&L. Simple standard, just keep your calm and attend the examination. You will score 5 out of 5. Definitely, this is my guarantee, right? Now, you had some conditions. The conditions were not satisfied. What will you do? Your parent give you an iPhone saying that you scored 60 plus in accounts, and you did not score 60 plus in accounts. They will take back the iPhone. Same thing. Government has given you grant. You don't fulfill the conditions. Government will take back the grant. Now, what to do when the government takes back the grant? Simple. What did you do when the government gave you grant? I reduced from the cost of asset. Okay, add it back to the cost of asset. No. I credited it to deferred income account. Debit it to deferred income account. No. I had credited to capital reserve. Debit it to capital reserve. Sir, but there is no balance left in deferred income account. Debit it to P&L. Simple, right? Whatever was the treatment given earlier, you have to reverse that. So, for example, the reason why I said 2 years, value at the end of year 2 is 2000, and the government says, I gave you a grant so that you can do something. You did not do those things. Please give back the grant. What was the grant amount? 6,000. Okay, add grant refunded 6,000. Then carrying amount, how much? 6,000 plus 2,000, 8,000. What is the balance useful life? 2 years. Depreciate it over remaining 2 years. In this case, over a period of 2 years, amount transferred to other income will be 3,000. Correct? What is the balance left in deferred grant account now? 6,000 is what we received. 3,000 you have transferred to other income. So this balance is 3,000. So what will you do? Debit deferred grant 3,000, and we have to refund 6,000. Balance debit P&L. Just reverse the impact that you had taken or that you had given earlier. As simple as that. Okay. So this concludes government grant. Let me see if you have some questions here. No questions. Okay. So moving on, accounting standard 13. I will keep accounting standard 13 discussion brief because there is a separate chapter on this, and concepts I'll definitely cover it here. And based on this concept, you should be able to solve the questions on this chapter. Accounting standard 16 is where you will be spending a good amount of time, and then we'll take up a past exam paper. Okay. Accounting for investments. What are investments? Investments are assets held by enterprise for earning income. So these are assets held by enterprise to earn income. How? Dividends. They would get dividends, or they would get interest, or they would get rentals. When I say dividend, maybe they have acquired shares. When I say interest, maybe they have invested in some bonds or some debentures of any company. When I say rentals, maybe they have purchased an investment property. Okay. So these are the assets. Again, AS2 also we talked about assets. AS10 also we talked about assets. Even AS13 is about assets. If they are held for earning income by way of rentals, then we call them investment. Okay. That is one thing we need to understand. Or if not for income, for capital appreciation. I purchase shares of a company. The company doesn't pay me dividend, but after 5 years, maybe the share value will be double or triple, maybe possible, right? So then that is also called as investment. And for other benefits to the investing enterprise. So some other benefits may not be capital appreciation, maybe some other benefits for the investing enterprise that the entity which is investing is making. Okay. Assets held as stock in trade are not investments. So what is the meaning of this? Say there is a builder. The builder has a lot of buildings, but those buildings are inventory. When those buildings are inventory, can I classify them as investment as per AS13? No, I cannot classify them, right? They would not be investment because they are inventories. Similarly, if I keep on purchasing and selling shares as a business, I purchase in the morning, I sell in the evening, purchase today, sell tomorrow, I treat it as a trading activity, then it is not considered to be an investment. Okay, because it's considered to be a stock in trade, right? So this is the gist of the definition of investment. Then there are two types, current and long term. This is one aspect which gets tested quite often in the examination. What is current? Current means it is readily realizable and not intended for more than 1 year. You want to sell it off within 1 year, then it is current. Otherwise, it is long term. If it is current, you will value it at lower of cost or fair value. You will value it at lower of cost or fair value. Difference will go to P&L. Difference will go to P&L. I think I wrote a mistake. Maybe I was copying that. This is also P&L. Okay. Maybe I was copying this out earlier, so an error there. Sorry. Yeah. Then long term, which is other than current, it is always carried at cost. General principle: current investments lower of cost or fair value. Long term investments always at cost. Then what is the exception? If there is a decline other than temporary, so there has been a continuous decline in the value of investment and it is not a temporary decline, then you will bring it down to its fair value, and in that case the difference will be taken to P&L. Okay. Now, as far as costs are concerned, how do we calculate cost? You will take the acquisition cost, that is the cost that you pay to acquire that particular investment. Brokerage, please remember brokerage, when you sell also there will be brokerage. So brokerage is given as percentage. Let us say brokerage is 2%. This is always on transaction value, not on face value or par value. You will receive dividend on face value. The brokerage is always paid on transaction value. So if you buy something at, let us say 150, brokerage will be 150 multiplied by 2%, which is 3. So your cost will be 150 plus 3, 153. If you sell at 150, you will pay brokerage of 2%. Sometimes in the exam they give a different buying commission and selling, buying brokerage and selling brokerage. Okay, 3. So what is your say? Net sale value? Net sale value will be 150 minus 3. 147. I've seen students making mistakes here. Even while selling, they'll add brokerage to the sale value and you will lose marks. Okay, so buying brokerage will be deducted, buying brokerage will be added, selling brokerage will be deducted from the proceeds. Okay, so what does cost include? Acquisition cost, brokerage, any other duties which are paid. Okay, so this is the concept of cost. If securities are issued to acquire investment, then you will take the fair value of the investment. If other assets are given up, then fair value of asset given up or acquired, whichever is more evident. Okay, so if shares and securities are issued, you will do the fair value of investment, that is the investment that you have acquired. If other assets are given up, then fair value of the asset given up or fair value of asset acquired, whichever is more evident. Now don't confuse this with the exchange transaction in AS 16, AS 10. Okay, AS 10, property, plant and equipment, that has a specific requirement of considering the fair value of asset given up, whereas here fair value of asset given up or acquired, whichever is more evident, whichever is more clear, whichever you are more comfortable with, that is the value you would be taking. Okay, and if at all there are pre-acquisition dividend or interest, you will reduce it from the cost. Now here again there is one concept called cum interest and ex interest. Okay, cum interest means cumulative of interest, ex interest means excluding interest. Now whenever you do investment accounting, in the investment portion, you will always take excluding interest value. You will always take excluding interest value. Now why would this kind of confusion arise? Say for example, you purchased a security on 1st of September of 21. On 1st of September of 21, you purchased something which has a face value of 100. Okay, and it has an interest rate of, let us say 10%, I'll make it 12%, right? And interest is due. Interest is due on 30th of June and 30th of December, right? You purchased on 1st of September. When did you purchase? 1st of September. When was the last interest paid? 30th of June. Now, someone who is selling you this particular investment, will he just sell you at 100? No, he will also say 100 is the value of this investment. I'm taking 100 for simplistic reason. The value of investment may be 102, 103. It could be premium discount. We are ignoring all of that. Let us assume value of the investment as such is 100. And on top of it, for July and August, here is again one mistake what students do. If it is given 1st of September and here 30th of June, June, July, August, September, don't take it 4 months. 30th of June, so start from July and August, 2 months. What is 2 months interest? 100 multiplied by 12% divided by 12 multiplied by 2, you get 2 rupees. So total amount that you will pay is 102. This is called value. It's called come interest value or come interest quote. Okay. Now you paid 102. Why did you pay 102? You paid 102, 100 towards principal or face value or investment cost, 2 towards the interest portion, right? So you'll split that and you will account the investment at 100, and this 2 will be considered as interest receivable. So the entry would be investment account debit, which is 100, interest receivable debit, which will be 2, and to bank, which will be 102. This you will show in the income column in the investment account if required, and this will be shown in the cost column of the investment account. You will always value it at X interest, and if there are pre-acquisition dividend or interest, in our case I took an example of interest, there could be a pre-acquisition dividend as well. Okay, those are reduced from the amount that you are paying for acquiring that particular investment. Okay, then we have the thing of rights issue. What happens in the case of rights issue? If subscribed, normally if you are buying an investment, same treatment. If entitlements are sold, so you have rights, you have entitlement to subscribe to the rights, but you did not subscribe to the rights, but you sold those rights. In that case, whatever proceeds are realized, you will credit it to the P&L. And if investments are acquired on come right basis, so you purchase some investments on come right basis, right? And the price falls after the rights issue. So I bought on a come right basis, and the rights issue happened, and after the rights issue it falls down. In that case, you may reduce the sale proceeds from the carrying amount, because the price has fallen because of the rights issue, and I have purchased the shares on a come right basis. This is only when there is a right issue which is pending. You cannot do this if you have already purchased it 2 years back, and today the company has come up with rights issue and there is a fall in the value of rights. You cannot, reduce the sale proceeds from the cost of that rights or cost of the share. You have to credit that to P&L. This is done only when they are acquired on a come right basis, means rights issue have been announced by the company, right? This is about investment accounting in a nutshell. Now let us move on to the next aspect of disposal. So whenever there is a disposal of investment, difference between the proceeds and carrying amount will be credited to the P&L. You will use weighted average basis of computation. You will not use first in first out, you will use weighted average. Reclassification, current to long term, lower of cost of fair value, long term to current, lower of cost of carrying amount. Now when you are classifying an asset, when it was a current asset and now it has become a long term investment, then you will see what is the cost, what is the fair value, whatever is the lower of the two amount, at that value you will reclassify them as long term investment. Okay, and if you are reclassifying something from long term to current, you will see what was the cost, what is the carrying amount, whichever is less, at that value you will reclassify them as current investments. Now moving on to borrowing cost. Let me check if you have some questions. If date is given in middle of the month, how to calculate? You may use number of days to calculate that. Generally, they will not give it, but if they give it, you can use the number of days. Pre and post acquisition dividend. So, pre and post acquisition dividend. For example, let us say you purchase some shares on 1st of April. Okay, 1st of April, and the company declared some dividend on 30th of June of 21 for the financial year 2020-2021. Okay, so when did you purchase? You purchased here. When did the dividend come? Dividend come in on 30th. The dividend was declared on 30th of June. When is that dividend pertaining to? It is pertaining to this particular financial year. Then in that case, from this cost, whatever you have paid, you can reduce the dividend amount. You can reduce the dividend amount because dividend is pertaining to a period before acquisition. Okay. Now coming to borrowing cost, again a simple standard which talks about capitalization of borrowing cost. Which talks about capitalization of borrowing cost. Very simple concept. Okay. It requires either you may get a theory question which asks you about what is a qualifying asset, not a qualifying asset, can be capitalized, can be not capitalized, or calculate the amount of borrowing cost to be capitalized. What is borrowing cost? Cost incurred for borrowing. If you have borrowed some amount, if you have incurred certain cost, that is called borrowing cost. Okay. Now here, this is very important. Okay. Here you may get confused slightly. We'll discuss this with an example. But apart from that, borrowing cost includes interest and other commitment charges on borrowing. So whatever interest you are paying, that is a borrowing cost. If there are any discount and premiums related to borrowing, then also it's a borrowing cost. What does that mean? You have issued, let us say, 100 rupees worth of debentures at 95. So you got 5 rupees less. That 5 also forms part of borrowing cost, and you have to amortize that over the life of the debenture. Okay. Similarly, if you are repaying a borrowing, if you are repaying a debenture at a premium, that premium is also a cost that also has to be amortized over the life of the borrowing. Then any other cost incurred in connection with arrangement of borrowing, you may pay some processing fees, you may pay some consultancy charges, legal charges. All of the costs which are associated with borrowings are called borrowing costs. Okay. And if you have acquired an asset under finance lease, you'll understand that in group 2 AS19, finance charges in relation to these assets are also called as borrowing cost. Now, what do we do with this borrowing cost? Borrowing cost, if it is in relation to a qualifying asset, then you will capitalize. Otherwise, you will expense. That is the treatment. And one aspect, what I told you in the beginning, exchange difference arising from borrowing, foreign currency borrowings, to the extent they are regarded as adjustment to interest cost, even these are called as borrowing cost. Now, how do we calculate that? Let us take an example. Generally, as I told you, interest rates in foreign countries, let's say interest rates in US, they are generally less. Okay, so today also, if you want to go and let's say borrow in USD, you may get at 3%. I'm telling you, 2% to 3%, 1%. In fact, we have done transaction at 1.5% also, right? I'm not sure of the exact rate, but assume you get it for 3%. Okay, rates are generally lower than in the developing countries. And what is the rate here? Interest rate in India is 7%. Okay, now you got a wonderful business idea. I will borrow in USD, lend money in India, I'll pay 3% interest there, 7% interest I'll earn, and I'll make a lot of money. Friends, it is not so simple. What happens is, as we have seen in the case of exchange rate, because of this interest rate parity, so there is a theory called interest rate parity theory. Based on that, because there is an interest rate differential and there is an arbitrage opportunity, you can borrow in US and you can lend in India and you can make 4%. If it is so easy to make money, everybody would jump into this business and they would make a killing out of it. But it is not so simple. What would happen is, interest rate will go from, interest rate differences is there. But from the time you borrowed the foreign currency loan to the time you repay the loan, you have to pay an additional amount by way of exchange difference. Remember, let us assume date of loan is 1st April of 21. Date of loan is 1st April of 21. Amount of loan is, let us say, $10,000. Amount of loan is $10,000. Exchange rate on the date of borrowing is say 70. Okay, and for a moment assume exchange rate on 31st of March of 22, that is after 1 year, maybe settled or maybe unsettled. It is 75. Exchange rate is 75. Okay, now what happens here? How much is the exchange loss? You borrowed something at 70 and now you have to pay 75. You have to pay 75. What is the exchange loss? Exchange loss is 75 minus 75 rupee per dollar multiplied by $10,000. You have an exchange loss of 50,000. You have an exchange loss of 50,000. Now, what is the interest you have to pay in USD? you have to pay 3%. You have to pay 3% on what amount? $10,000. So I'll just type it here. $10,000 multiplied by 3% multiplied by you have to pay 75. Okay, provision or payment, whatever it is. So how much is that? 10,000 multiplied by 3% multiplied by 75. That comes to 22,500. 22,500 is the interest you will pay on the USD loan. Now, what the standard wants to do is, what would have been the interest had you borrowed in India for equivalent amount? Now, what is the amount we borrowed? We borrowed $10,000. $10,000 we borrowed when the rate was 70. So in Indian terms, we actually borrowed 7 lakhs multiplied by 11%. Oh, sorry, 7%. How much is this? 10,000 multiplied by 70 multiplied by 7%, 49,000. So because of my borrowing in US, I have saved interest. I would have paid 49,000 in India. I'm actually paying only 22,500. What is the savings in interest? Savings in interest is 49,000 minus 22,500, which is 49,000 minus 22,500. I saved 26,500 on interest, but I paid 50,000 extra by way of exchange loss. I paid 50,000 extra by way of exchange loss. Now, what the standard says is, whatever is this exchange loss, out of that, how much is compensating your savings in interest? Sir, 26,500. This you treat it as borrowing cost. I'm repeating. Out of the exchange loss, how much is the savings in interest that is being compensated? Entire 26,500. So 50,000 out of 50,000 of loss. Compensation for interest is 26,500. Balance exchange loss, which you can consider for AS11 purpose, is 50,000 minus 26,500, which is 23,500. Are we clear? Now, what if, I'm just changing the example, exchange rate instead of being 75 was 72. Exchange rate instead of being 75 was 72. What is the exchange loss? 20,000. What is the savings in interest? 26,500. Now, this entire 20,000, in the second case, the entire 20,000. So here you will not say 26,500, you will say 20,000 is compensation for interest. There is no balance exchange loss for AS11. So you will not take anything to AS11. First, you will apply AS16 to the extent of savings in interest. You will, treat it as a borrowing cost, and balance will go to the balance will go for treatment under AS11. So the formula could be lower of exchange loss and savings in interest. This you will consider as a borrowing cost. Please note this down. Lower of exchange loss and savings in interest, whichever is less, that to that extent will be treated as borrowing cost. Under which principle? Under this last principle. Exchange differences arising from foreign currency borrowings, to the extent that they are regarded as adjustment to interest cost, to the extent they are regarded as adjustment to interest cost, that will be considered as borrowing cost. Okay, this is all about borrowing cost. Now, what do? Borrowing costs which are attributable to acquisition, construction, or production of a qualifying asset should be capitalized. Remaining will be expensed. Okay. What is qualifying asset? Which necessarily takes a substantial period of time to get ready for its intended use or sale. Intended use covers accounting standard 10 property, plant and equipment, covers intangible assets accounting standard 26. For sale covers accounting standard 2 inventory. So if there is a qualifying asset which takes substantial period of time, then to that asset you can capitalize borrowing cost. What is substantial period of time? Presumption 12 months or more, unless you can justify it otherwise. So there's a presumption. Sometimes the period may be longer, sometimes the period may be shorter. It is purely on the call of the entity, right? Then how do you compute? If there is a specific borrowing, what is the meaning of specific borrowing? I am constructing a building. For that building, I have taken a loan, and that loan amount, I am using it for the purpose of the building. So I can identify this loan is going for this particular building. That is called specific borrowing. If it is a specific borrowing, you will take actual borrowing cost less income on temporary investment. So sometimes what happens is you may not be utilizing the full amount of borrowing. You may have invested it somewhere temporarily. Then in that case, investment income will be reduced, and actual borrowing cost which is incurred minus temporary investment income will be capitalized. Okay, that is the part related to specific borrowing. If it is a general borrowing, the entity has multiple different borrowings. They have issued debentures, they have taken bank overdrafts, they have taken term loan. You cannot identify which loan is taken for which asset. Then you will calculate a capitalization rate. What is this capitalization rate? Weighted average interest rate. What is this? Weighted average interest rate. And based on the amount of expenditure, you will apply this capitalization rate and you will compute the amount of borrowing cost to be capitalized. Okay, that is the second aspect. Now, sometimes in a question, they may give you specific borrowings as well as general borrowings. So we can assume that specific borrowing was applied first, and then you can take the rate related to general borrowing. Okay, when should we start capitalization? Three conditions: expenditure is being incurred, borrowing costs are being incurred, and activities are under progress. If these three conditions are satisfied, then you can capitalize the borrowing cost. When do you suspend? During extended periods when active development is interrupted. Meaning to say, let us say there is a qualifying asset, but because of some unforeseen reason, there is no activity which is happening. These activities are not under progress. Why? Maybe because of labor strike, maybe because of material shortage, it was not available. You see, right, chip shortage happening, coal shortage happening, unknown, abnormal things which were not anticipated. Then in that case, if active development is interrupted, then you will suspend the capitalization. So this happens in case where there is an inordinate delay which was not anticipated earlier. But if the delay is a normal part of the project, bridge is being constructed and you know that the water levels will keep on rising, in that case, is it not a part of the construction process itself? Was it not known that during few months of monsoon, the bridge water level would rise and you will not be able to do construction during that period? If that is the case, then you will not suspend because it is a part of the project. Okay, cessation, when do you stop? Where substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are completed. So once the building is ready, let's say building, we are talking case of building is ready for its intended use and sale, then you can stop the capitalization of borrowing cost. Building is completed, you have not yet installed the call bill. Does it mean you cannot capitalize? You have to. Does it mean you can continue to capitalize borrowing cost? No. Just that call bill is remaining, right? Substantially the building is ready, stop capitalization of borrowing cost. Or some puja has to be done, some murat has to be found out. Those are all decorative things. Those are all ancillary things. Is the building ready for its use? Yes, then stop the capitalization. Okay, you have to check it on part to part basis. So let us say a project has 5 blocks. 3 blocks are completed, 2 blocks are under progress. For those 3 blocks which are completed, you will not capitalize borrowing cost, right? So with this, we have quickly revised the balance 4 standards, and now it is time to take up a past examination question paper. If you have any doubts, I would be happy to help you. Just let me know. Maximum period for substantial period, there is no maximum period. Reclassification. Okay. Reclassification means you had acquired an investment and it was a current investment, but later on you change your mind and you convert it into a long-term investment. Then when you're reclassifying, what should be the amount you should recognize in the balance sheet? Lower of cost or fair value. Lower of cost or fair value. This is the same principle you apply to value current investments. Second, long term to current, lower of cost or carrying amount. Lower of cost or carrying amount. So from long term to current, if you are doing, you will check what is the cost and what is the carrying amount. See, when you value long term assets, you will always value at cost, or else if there is a decline, then you will reduce the value. So what is the carrying amount? You will see the carrying amount is, let us say, 100, cost is 120, lower of this to 100, that is the value at which you will recognize the current investment. Okay, so let me just pick up a past exam paper and help you understand how to you handle the questions in the examination, right? So let's take up the July paper. Okay. right? So if you see question number 1 is compulsory. A, inventory, exactly the same concept what we discussed yesterday, replacement of the cost or replacement cost basis and all of these things, right? So we'll do the computation and we'll see, right? Then or we'll take up question by question and then we'll solve it one by one. So don't get concerned with the length of the question. Sometimes the question may be lengthy, but you will be able to score full marks. You will be able to score full marks. Please focus on that. Joy Limited purchased 20,000 kilograms of raw material at 20. Joy Limited purchased 20,000 kilograms of raw material at 20 during the year 2021. Okay, their fund is the following information. Opening inventory, finished goods 2,000, raw material 2,200, direct label 3,06,000, fixed overheads 3 lakhs, sales 20,000. Sale amount is not relevant unless we have to calculate the compare it with the cost of finished goods. Closing inventory, finished goods 2,400, raw material 1,800. The plant has capacity to produce 30,000 units. Now, why is this 30,000 unit relevant? To calculate the overhead recovery rate. We understood yesterday, the total overhead divided by the normal capacity will give you the overhead recovery rate. However, the actual production during the year 2021 was only 20,400. So actual production also has been given. See, you can calculate using this also. Opening inventory or sales plus closing inventory minus opening inventory is 20,400, right? So that is given directly in the question. Due to fall in market demand, price of the finished goods in which the raw material has been utilized is expected to be sold at 40. Here, 20,000 units are being sold at 11,20,000. So that comes to about 55, 56 change, right? 55 or something change. Whereas, because of the fall in market demand, now it will be sold only at 40, and the replacement cost of raw material was 19 per kilogram. When we purchased, it was 20 per kilogram. Now it is 19. You are required to ascertain the value of closing inventory as on 31st of March as per H2. Now, when I've corrected these kind of questions in the past, I've seen students, whenever the question asks value the closing inventory, they'll only value finished goods or they'll only value raw material. When they say finished value inventory, you have to value both finished goods and raw material. You have to value both finished goods and raw material. Now it's a very simple thing here. How much has been produced? 20,400 units have been produced. This is reconciled by looking at it. What is the value of closing inventory of finished goods and raw material? That is what we need to explain and determine, right? So now here, what is the raw material cost? Raw material cost is $20 per kilogram. Okay. And in the past also they have been purchased at 2,200 into 20. So no complication there as well. Okay. Direct labor is 3,06,000. You can add here total. You not add also. You'll see the presentation. This multiplied by 20,400. Okay, that is what is produced. Direct labor. What is the direct labor? 3,06,000. So if it is 3,06,000, how much it is per unit? This divided by 20,400. This is the production. Okay. Right. Then overheads. How much is the overhead incurred? Now you cannot absorb everything in the production because you have to calculate fixed overhead recovery rate. So overhead recovery rate is equal to 3 lakhs divided by 30,000. How much is that? That is 10 per unit. So here fixed overhead will be 10 per unit. So this multiplied by 2,400. Total column need not be mentioned. I'm just writing here for your understanding. Okay, 10. Right? Are there any other costs? There are no other costs. So what is the cost of inventory? Finished goods. Cost of finished goods is 45. What does the question say? Finished goods will be sold at 40. So are there any selling expenses given? No selling expenses. So sale value is 40. So what do you value? How do you value finished goods? Finished goods are valued at lower of cost or net realizable value. In this case, NRV is 40, which is less than cost. Hence, finished goods will be valued at 40. What is the value of finished goods? Value of finished goods will be number of units of finished goods, which is 2400 multiplied by 40. Okay, at NRV. At cost. Cost will be 2400 multiplied by 45. So that will be 2400 multiplied by 40 and 2400 multiplied by 45. Okay, so NRV is lesser, so it will be valued at 96,000. Now, value of raw material. If the finished goods, yesterday we discussed, right? If finished goods in which the raw material is incorporated will be sold below cost, then you will value the raw material at replacement cost. So, basis why? Because raw material finished goods is sold at less than cost, right? So what is the raw material? 1800 multiplied by replacement cost is 19. Cost basis 1800 multiplied by 20. If it was on cost basis, 1800 multiplied by 19, that gives you 34,200. 1800 multiplied by 20 will give you 36,000. So value of inventory will be 34,200 plus 96,000, 1,30,200, right? So this is how you can approach it in the examination. Okay, so let's see how it's been presented in the solution. Cost 45, right? So see, they have done it using aggregate and then divided it by number of units. You can present it in tabular format also, no problem. Since the net realizable value is less than cost, closing inventory will be valued at 40. Okay, then value of closing raw materials as NRV of finished goods is less than its cost. The relevant raw material will be valued at its replacement cost, which is at 19, and the closing inventory is 130. They have done this reconciliation. You can also do it in the examination. Okay, which may not be really relevant in this question because the question itself has said, 20,400, but it is good that you check it in the examination. Otherwise, if there is any balance figure, there may be a mistake. So we can add that. Raw material consumed. You will apply the concept of costing. What is that? Opening raw material plus purchases minus closing raw material. This is more for reconciliation. What is opening? 2,200. Purchases 20. Closing 18. So 2,200 plus 20 minus 1,800, that gives you 20,400, which is the consumption that we have considered while calculating this. Okay, it is clear from the question that 1 unit is used to manufacture 1 unit of finished goods. Now go back and check IPCC questions or CA inter questions. You will see that this kind of question is appearing in the examination every alternate attempt, almost every alternate attempt. I don't know what was asked in January 21. Let me just open this, and also let me open November. Machinery security. See, just now we discussed. They want to reclassify its investment long term to short term. 5 marks question. See, gives the following information of inventory, replacement cost, purchase price is given, finished goods is produced. This is the this units can be finished by incurring additional cost. So that will help you to calculate the net realizable value. Expected selling price is 280, subject to a payment of 5% of brokerage on selling price. Brokerage on selling price you will reduce. Then determine how you will calculate the inventory and calculate the value of inventory. Same concept, similar concepts that we have done. Same way it is being asked in this, asked in the examination. So this is the single concept which is tested again and again from accounting standard 2. Let us look at what was asked in January. or was this November? I don't know. Grant, investment in shares, and this is the one related to borrowing cost. So here it was not asked, but generally, if you see concept, this is the concept that will be tested. Okay, let's move ahead. This is in relation to AS10, a very straightforward question. A Limited has contracted the supplier to purchase machinery which is to be installed at its new plant and machinery. Okay, special foundation were required. Okay, the cost of site preparation and laying foundation was this. Sorry. Sorry. Yeah. Cost of site preparation and laying foundation. Will it be included as a part of cost of fixed property, plant and equipment? Yes, because these are incurred for getting that PPE into its current condition and location. Activities were supervised by an architect during the entire period who is employed for this purpose for a salary of 3,500 per month, 35,000 per month. Again, can be, you can make a mistake in the examination here. 35,000 per month. How many months? 4 months. We'll take only 4 months period. Okay. Just don't take 35,000 and be done with it. Machinery was purchased for 1 crore 27 lakh 50,000. Okay. This was incurred on transportation. That will be included. Engineer was appointed at the fees of 37,500 to supervise the installation of the machinery at the plant site. Will you include that? Yes. You are required to ascertain the amount at which machinery should be capitalized in the books of A Limited. So here you have to say that all the costs which are incurred to bring that property, plant and equipment in the condition and location to be operated in the manner as intended by the management, those costs will be capitalized, and then we can just include all of these costs. Okay. Second question. It's there in the study material also. B Limited, which operates major chain of retail stores, has acquired a new store. New location requires substantial innovation expenditure. Now, this innovation expenditure, if they are necessary to bring that store in the condition and location as intended by the management, will capitalize. Okay. Management expects that it will last for 4 months, during which the store will be closed. Management has prepared the budget for this period, including expenditure related to construction and remodeling, salary to the staff before its opening and related utility costs. How would such expenditure be treated in the books of B Limited? So, if they are necessary to bring the store to the current condition and location, the remodeling and reconstruction will be capitalized. But if those employees' cost and all of that represents idle time of employees, which should anyways have been incurred, it is not specifically in relation to this particular store, then it will not capitalize. Here both the arguments can be given. Received the following grants during the year ended 31st March. 120 lakhs received subsidy from the central government for setting up an industrial undertaking in a notified backward area. Grant in the nature of promoter's contribution. Credit to capital reserve. 15 lakhs from central government on installation of effluent treatment plant. Grants related to depreciable asset, either reduce it from the cost or take it to deferred income. 25 from state government for providing medical facilities to its workmen during the pandemic. Okay, so already the expenses have been incurred. You can direct credit it to the P&L, or if you believe that the pandemic is still going on and they have to continuously provide, then you can set up a deferred grant account. See, such simple questions in the examination. 5 marks. You cannot lose marks in these kind of questions. Right? Cash flow. It's a straightforward question. They are given a cash summary account. You have to prepare a cash flow statement. Just need to pick up the correct amount and place it at the respective places. It is done. Right? And let us look at this. On 15th April, they obtained a term loan from bank of 320 lakhs to be utilized as under construction of factory set. Assuming now, in this case, you always write an answer saying that it is assuming that this factory shed construction is a qualifying asset. Then you will capitalize. Purchase of machinery, generally, if it is an outright purchase, it will not be a qualifying asset, so you will not capitalize. Working capital is definitely not capitalized. Purchase of vehicles, again, ready for use, will not be capitalized. Advance for tools, cranes, and purchase of technical know-how. So, depending on whether you treat this as qualifying asset or not, accordingly, you will categorize this as capitalization or not required to be capitalized, right? Purchase of technical know-how, already ready to use, right? So there is nothing to be capitalized in that context. Okay, so again, 6 items, you get 5 marks for correct explanation. Now in these kind of questions, the advantage with you is, even if you are confused in some cases, Even if you are able to write 3 or 4 answers correctly, you'll get 3 to 4 marks. You should not be losing marks in the accounting standard related questions. Question on investment, question on government grant, question on depreciable assets. Okay. Right? Any more questions if you have in relation to accounting standards that we have been discussing for group 1, please let me know. I'll be happy to take that. Otherwise, we'll call the session, and we'll see if we can plan accounting standards for group 2. We'll let you know. You can keep following the app on that. So accounting standard 12 talks about government grant only. That is, you have to receive it from the government, the central government, or the state government, or the government authorities. Other grants are not covered by this. Now, let us say they have received grant from some other company. Then, okay, if the grant has been received, you may reduce it from the cost of those respective assets and present it in the balance sheet. You may apply similar principles, but that will not be covered by AS 12. Why not to capitalize purchase? Why not to capitalize purchase of machine? Because machine is in a ready to use condition. See, qualifying assets are those assets which take substantial period of time to get ready for their intended use or sale. Now, if you are buying a machine, the machine is already ready. Had the machine taken 2 years to be constructed and you are giving advance for that machine, then it can be called a qualifying asset. Otherwise, you will not call it a qualifying asset. MTB problems also would be similar. If you want, see, I have some 10-15 minutes. I can take up a couple of questions from some more past exam papers. Let me just share the screen. Okay, so and just randomly I'll pick up some paper, maybe November 19 paper. We can have a look. Older questions are not there. I can and see. Prepare cash flow from investing activities. Only investing activities. You need to identify what are investing activities and prepare. I don't think it is very difficult to prepare cash flow from investing activities in such a case. Okay. Then head office in Mangalore has a branch in US. Trial balance is given. Prepare trial balance after being converted into Indian rupees in accordance with AS 11. Okay. So here goods have been sent by head office and all of that. So you can assume this to be an integral operation and then do it as per the accounting for branches question. Then inventory, again, same question. 2 years back also same question. They just changed the numbers. They just changed the numbers and similar questions are asked. This is for deferred taxation, which was earlier there in group 1. Now it is not there in group 1. So, you can. I think machinery I gave the response to. Group 2S will get to know. We'll announce a date on that if feasible in the next over a period of 1 to a week, 10 days. We'll do it. Deferred tax is a part of group 2, will not be considered here. Let us go back to some older questions. Institute doesn't have them here. You can have it on our website. You can just go to indigolearn.com and you can download it. See, I have tried my best to cover the standards in summary in revision form. If you are still finding it, difficult to understand some critical concepts, we have this individual accounting standards module sale available. You can take the benefit of that at 199 rupees by using ICAS. It will come to around 150, 160. You can spend a couple of hours and master that particular standard. Right. Accounting standard 20 is fully available for free on our YouTube channel. You can make use of that. And past exam papers, you can download it from here. So let us look at some previous year papers prior to 2019 that is not available in the institute website. So May 18 paper, if you have a look at it, let me just sign in. Okay, so May 18 paper. Let us see what was the On 1st April, XYZ Limited received a government grant of 100 lakhs for an acquisition of new machinery costing 500 lakhs. The grant was received and credited to the cost of the assets. The lifespan of the machinery is 5 years. Machinery is depreciated at 20% WDV. Now, this question is slightly incorrect because if it is a WDV method, 20% rate of depreciation would not be appropriate unless we assume that at the end of 5 years the residual value will be so much. Okay. Company had to refund the grant on 2nd April 2017. So on 1st April 14, you have received due to non-fulfillment conditions. How would you deal with the refund of the grant? Now, in these kind of question, what you need to do is you have to first explain. You have to first explain the theory, because the question says, how do you deal? So you explain the theory, how do you deal, and then give the working. So at the time of acquisition, you would have reduced it from the cost of the machinery. So 500 lakhs minus 100 lakhs, 400 lakhs, you would have reduced it from the cost of machinery. If you have assumed that the question itself says it is received and credited to the cost of asset. So 400 lakh is the cost of asset. 20% depreciation for first year. So 400 multiplied by 20% makes it 80 lakhs for the first year. In the second year, it will be 64 lakhs. How 64? Because 80 into 80%, 64. Then 64 into 1st April 14. So 31st March 15, 31st March 16, and 31st March 17. You have to calculate depreciation for 3 years. 80 multiplied by 80%, 64. 64 multiplied by 80%, 51.2. This is the book value. Then you refunded the grant. You will add back the refund. Revised book value 304. Now on this, 20% will be charged as depreciation for the next 2 years. Okay. Obviously, you'll have to go back and check the residual value, carrying amount, and all of those things as per AS10. That is fine. But as far as AS12 is concerned, this is how you'll present the answer. Now, this concept and there is a straightforward 5 marks just given to you on the platter. Nothing complicated. Okay. Then ABC Limited borrowed 500,000 on 1st July of 17, which was repaid on 31st July of 17. So 1 month. ABC prepares its financial statement on 31st March 17. No. So this is not July. This is 1st January. Oh, okay. So one more thing, in examination, sometimes you'll get these kind of errors. So you have to look at the question carefully and make an assumption. So what they have taken as an assumption in the solution, they have not mentioned anything, but by looking at the question, you can figure out that this is on 1st of January, because loan, 1st of January date is loan here. 68.5 is the loan. 31st March, it is 69.5, means we have to pay 1 rupee extra. So how much is this? 5 lakhs multiplied by 1. You have an exchange loss of 5 lakhs. Then when it was repaid at 70, exchange loss of another 2,50,000. You are required to pass entries in the books as per AS11. Okay, so your interest is not involved. You just need to calculate the exchange difference. Now, what is possible? First assumption is that the entity has not opted for 46A. You will debit it to P&L. Second assumption, entity has opted for 46A. Then you will add it to the cost of the depreciable asset. Okay, so that is how you will have to write the answer. Simple. Bank account restatement, whatever we have, first entry is for borrowing, second entry is for restatement, third entry is for settlement of the account. But here, please note, they have not passed an entry for transferring it to P&L. That also needs to be included. So this on 31st March, this restatement of 5 lakhs should be transferred to P&L as well. So you have to write that entry. They have not given, but you have to write that entry. Here, foreign exchange difference account at the end of the financial year, that has to be transferred to the P&L account. Okay. Deferred tax is not a part of our group 1 right now. So again, this question number 4 is also not a part of our accounts. Okay. Individual mock tests are available as a part of your course. Okay, so you can consider that. I think we have covered some questions. We have seen some approaches to attempt these questions. Practice, be very thorough with your concepts by revising. At least I'll tell you, last 4-5 years, 4-5 attempt question papers related to accounting standards and the document that I've given. You will be in a good position to answer the accounting standards related question in the upcoming examination. Okay. I hope the revision was useful to you guys. And if you liked it, you can come back. The first part is available on YouTube. This part is also available on YouTube. Okay, you can, if you want to download the notes, it is available here under CA Inter Paper 1 Accounting. No, sorry, not here. Under the notes section, you can download it from here. Here is where I have put this particular summary notes. You can download this and you can access this. Any more questions? You can feel free to use the forums that we have. Right. All the best for your exams. We'll see you soon again with another revision session if possible.